Hi everyone. So this is part two of your chapter one. We are now going to discuss the accounting equation, which is assets is equal to liabilities plus capital. All right. So we will use the example from your textbook, the Lena example, which is found on page 5 of your book. In this example, Lena here wants to start her own business, which is the dress shop. So there are four transactions here. For walkthrough 1.1, you can look at your book to see the whole page. For page 5, it's all about Lena. And then I'm going to discuss the corresponding answer to this walkthrough in the next slide. Okay, so in here, if we recall, the definition of accounting equation is that your assets is equal to your liabilities plus capital. And then if we try to recall what we talked about in the first part of the video, assets is what the business own, and whatever the business owns comes only from two sources. It's either from your you borrow money from others, or you borrow money from the owner. All right. So why is this like this? Because we've talked about this, that your the money that is from the owner should be always separate than that of the business. So the moment that the owner puts investment or money or capital into the business, that is now the business property. All right. So we separate the owner from the business. If I am Miss Marie and I open my own grocery store, I have to separate my personal money with that of my grocery store. The same here for Lina. Okay, so for Lina here, she opened a business bank account to start her own business, to start the dress shop. So the assets here will go up by 20,000. Now you will think, where is this coming from? Where is the source of this asset? How did we come up with this 20,000 in the bank account? Did we borrow from the bank, from the friends, from the family members? No. Okay, where did we get the money from? We borrowed this from the owner. So your capital here is at 20,000. Now you look closely at the left side and look closely at the right side, then you will see that they are both equal. The equation is equal. Assets is equal to liabilities plus capital. All right, we go to the next one now. The business purchased premises 15,000 and paid by check. Of course, if you start your own business, you will now start buying goods, you know, finding a place for you to put your shop. In this way, in this case, Lena purchased premises. When we say premises in accounting, it means like the building that you are actually putting your business onto. So, premises here. Okay, so your premises here, you bought 15,000. Okay, when you bought this premises, where did you get this money from? Okay, where did you get the money to buy this premises? So I got this from, did I borrow this from others? No. Did the owner invested another or a new capital? No, so this remains fixed at 20,000. So where did we get the money from? Naturally, we got it from the bank. So instead of now having a bank of 20,000, we now only have a bank of 5,000. And why is that so? The first transaction here, your bank is 20. Now you use some part of the money to buy your own building. So now you have a new building worth 15,000, but your bank went down by 15,000, which is now down to 5,000. The total assets, if you add both of them, is equal to 20,000. And your capital is also equal to 20,000. So as of now, both of them are still equal, right? Now, take a look closely at 1 and 2. I'll give you like 20 seconds or 10 seconds just to go over them. Read again 1 and 2, the changes that happened in between. Okay, so yeah, all right. So now on the third one, we now have we purchase now goods on credit. Right. So first, we set up a business, we put money, which is 20,000. Next day, we bought a building. Right. Now we are ready to start our business. The third thing that we have to do now is to purchase what we need to start the business. So if you're a dress shop, perhaps you need the dress, right? Because your Lena here is actually opening a dress shop. So perhaps she's like preparing all kinds of of stuff for her own business. So perhaps she's going to buy clothes or anything that's related to the dress shop. In this case, it says here the business purchased goods on credit worth 3,000. Okay, so if it's 3,000 and it says here, look at the word, it says here on credit. On credit. I will highlight that in yellow so you see that. In accounting, when we say on credit, it means we pay later. Pay later. So the business purchased goods on 3,000 by 3,000. What is now the effect on this one? So your premises is still there, your building is still there, you're still using it. Your bank, did you get money from the bank to buy these goods? No, you didn't. So your bank remains at 5,000. But your goods here or your inventory, you now have goods amounting to 3,000. Okay? Now, what is the effect here? The effect is you actually borrowed money from others because it says here you purchase goods on credit. So you got the goods, but you told the person or your supplier that I am going to pay on a later time or on a later date. Okay, so in short, my liabilities will now be trade payable. Trade payable is a business term that we call to people that we borrow money from. So you actually borrowed money by 3,000 and then your capital remains the same at 20,000. Now take a look closely. You can use your calculator, but you can do mental math as well. If you add all of this, it's 23,000. And here, it's also 23,000. All right? Okay. Now, the fourth one. So if you look at this, sorry, let's just revise quickly a little bit. The total of your right side, if you add all of this, the trade payable and the capital is 23,000, and your assets on the left side is also 23,000. Now we carry on. On the fourth day, our premises is still there, our building is still there, our bank remains at 5,000. Now, what happens to your goods? What is the difference between what is the difference between 3 and 4? So this one, I will highlight this. It is purchased. This one below is selling. Okay? This is sold goods. The one on top is purchased. Later, I will explain again in the next slide the definition of purchases and sales. But what we're doing in number 4 is that we are actually selling now the goods that we purchased the previous day. Okay, so our building is there, our bank is still there at 5,000, but our goods now dropped by 1,000. However, it says again here that it's on credit. So it means the customer told you that they will pay you later. Okay? they will pay you later. So in short, you did not receive any cash at all as of this point. So the goods now decreased from 3,000, it's now only 2,000, right? But you now have to collect, you are now going to collect money from your customer because you sold goods and, and it's on credit. You call it trade receivable. I'll just remove this highlight here. Okay, so trade receivable of 1,000. Yeah, all right. And then, so you have your premises of 15,000, your bank of 5,000, your goods now drop to 2,000 because you sold 1,000 of them, but you have to collect that 1,000 from the customer. If you see this word, what's the root word of receivable? Receive. So you are waiting to receive money. Okay? In the upper part, it's called here trade payable. Why? Because the root word here is pay. You are going to pay it later. This one, you're going to receive later. Receive later 1,000 from your customer. Pay later 3,000 to your supplier. All right. Now, if we add this all again, trade payable, 3,000 plus capital of 20,000. Now, if you add all of this again, the accounting equation is still equal. So let's recall a little bit. The first day, 20 on the left, 20 on the right. The second day, 20 on the left, 20 on the right. Although the breakdown now changed because you bought the building or the premises. On the third day, you now have three items here. You have your building, your bank, and then you purchase some goods or products, but then you told your supplier that you will pay later. So it becomes a liability. And your capital there is fixed at 20,000. All right. The next transaction, the fourth one, you sold now some of the goods here. So the premises still at 15, your bank is still 5, but your goods went down by 1,000 because you sold it, and you are now ready to collect or receive money from your customers amounting to 1,000. Okay, I hope that's clear. So this is just to explain the accounting equation. Thank you for watching. So there's a part 3 of this video. I want you now to try, but don't worry about this. Anyway, I will clearly tell you the exercises or the test or understanding that you need to answer. But you can now answer this question, which is found on page 6. Okay, so the next topic that we will talk about will be how to use the accounting equation using the statement of financial position. That is in part 3 of the video. For now, I hope you understood how to prepare the accounting equation. Thank you.